relatively quiet week for macroeconomics, not least because of the US Thanksgiving holiday, the main top-down feature of the week could come from Europe in the form of two sentiment surveys, the IFO from Germany and the Courbe Synthétique or synthetic curve from no less than Belgium. Europe is wrestling with soaring inflation, high energy costs and rising interest rates, just like the US and the UK. And these two indicators should be timely as central bankers and investors try to assess the damage done to the economic bloc's economy. The IFO should be handy because Germany is Europe's largest economy, while the Courbe looks to be a pretty uncanny guide to the benchmark Euro Stoxx 600 equity index. Both figures are due out on Thursday the 24th. Now in October, Germany's IFO Business Climate Index fell for the fifth month in a row to a reading of 84.3. That compared to 97.9 in the equivalent month in 2021, and it was also the lowest score since May 2020, when COVID was the major concern. Respondents to the survey cited falling order books and sagging capacity utilisation rates at manufacturers, lower order backlogs in construction, and downbeat sentiment amongst retailers. Meanwhile, in Belgium, the Courbe in October fell to minus 15.5. That left the indicator 19.5 points lower than a year ago and represented the sixth straight drop in the reading. Services, industries and trade were actually more optimistic, but building and manufacturing industries less so than the prior month, with manufacturers noting high inventory levels as a particular source of concern. Bottom up, there should be plenty of corporate news back home to study in the coming week, as interim or full-year results and trading statements come relatively thick and fast, although only half a dozen or so are due from FTSE 100 firms. Names which may be worthy of further research include the following, although do please note some of these dates could yet be subject to change. Compass and Virgin Money on Monday the 21st, CRH, Telecom Plus, Cranswick, AO World, HomeServe and Babcock on the 22nd, United Utilities, Johnson Matthey, Halfords, Rotork and Britvic on the 23rd, Kingfisher, Intertek and Doc Martens on the 24th, and Mitchells and Butlers and Devereux on Friday the 25th. But the company which could just cause the biggest fuss in the week ahead is Severn Trent, the utility which provides water and water treatment services to around 8 million people across 4.5 million households in the Midlands of England, as well as a stretch of Wales from Wrexham to Welshpool, while it's scheduled to release its first half results on Wednesday, the 23rd of November. Shares in the FTSE 100 firm have traded in a wide range over the past 12 months, but the net result has been a gently modest decline. One reason for the big swing lower in the share price from spring's all-time high could be the effects of higher interest rates and higher government bond yields, factors which became even more acute during the chaos caused by Trussonomics in October. This is because in some cases, utilities are seen as bond proxies. Now, utilities such as Severn Trent do offer some degree of inflation protection to investors, as their revenues and dividends can be index linked, but they're usually not seen as a source of capital growth. Again, as a result, they're seen as bond proxies, since fixed income is also about yield and income rather than capital return. The higher bond yields go, the more attractive fixed income stocks look relative to utility equities and vice versa. So the relative calm in the gilt market after the sacking of Kwasi Kwarteng and the appointment of Jeremy Hunt as Chancellor may have helped Severn Trent's autumn share price rally. Now, analysts will be looking beyond the macro and to Chief Executive Liv Garfield for comments on all of these issues, and also how the first half stacks up relative to the company's guidance for the full year. She gave that alongside the annual results in May. Now, the key points then on offer were forecasts of an increase in sales of around 10% from the regulated water and wastewater businesses, high operating costs thanks to upward cost pressures on energy and chemicals, with further property sales contributing positively to partially offset that. Severn Trent's targeted 50 million in property sales profits by 2027, having already banked the same sum since 2017, although regulatory income could come in lower this year at 50 million against 79 million pounds for how Severn Trent compares relative to regulatory targets. Watch out also for any change in customer bad debts. Also, Liv Garfield pointed to an increase in the interest bill from last year's 269 million thanks to higher interest rates on the £6.5 billion debt pile. And that combination between it underpins analysts' forecasts for a drop in stated pre-tax income for the whole year to £187 million from last year's £274 million. Another big number to watch is capital expenditure, or CapEx. This peaked at around £800 million as Severn Trent got ready for the end of the AMP6 regulatory cycle, and is now, as it got ready for the AMP7, which is the current one. And CapEx is forecast to come in flattish against last year's £646 million for the whole of the year to March 2023. Lower CapEx can mean higher cash flow, and it's cash flow that funds the dividend. Always a key point for any utilities we've already discussed. Under AMP7, Severn Trent has a goal to raise the dividend in line with the CPIH inflation measure. Management has guided to a full year dividend of 106.82 pence against 102.14 last year. The interim payment a year ago, by the way, was 40.86 pence a share. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.